Hey guys, I know you're looking for stocks to buy and some updates on your favorite stocks, some fired up wealth favorites. I'm going to cover those today. I've been buying as well. The first stock I want to talk about AI stocks in general, the AI bubble. What's going on with some of our favorites like Nvidia and Broadcom and so on. I want to kick it off with Oracle, and I think it's important to understand the difference between some companies like CoreWeave, MBIS, and Oracle. They've kind of the bad actors, they're calling them, right? They've got this debt, and it's a lot different than something like a Broadcom or an Nvidia, or even like an Amazon, Microsoft, Google, and so on, right? So these are going to be kind of the bad performers. And there's some reasons that these stocks are being punished. Specifically, let's talk about Oracle here. So after earnings weren't great. You had a 16.5% drop, and then another drop, 42% from the peak of $345. And Oracle's core business, what happened is it generally has great cash flows. But in recent quarters here, Oracle has been growing aggressively to pivot. And I've talked about this before, but Oracle was a database company. It's pivoted many times. It's now pivoting into an AI services provider. And so they're spending massive capital expenditures, CapEx, on AI infrastructure, and that's actually turned their cash flow negative. I'll show you some charts here in a minute. The company carries over $80 billion in long-term debt, with quarterly interest expenses exceeding $1 billion. This is the problem. One of the problems, the other thing is the stock ripped, and it had a parabolic run, and you often see 50% retracements. So it's not really that unusual, but there also is a catalyst, right? There's going to be a fundamental catalyst that's helped driving the stock lower. But Oracle is building 72 multi-cloud data centers integrated with AWS, Azure, Google Cloud, and so on. These enable high-performance AI workloads with low latency and reduced costs by running Oracle databases natively. This makes sense because they're leveraging existing hardware. And what I mean by that, these are products that Oracle has been making for years, databases. So the demand long-term for AI infrastructure is going to surge, and over time, you will see this CapEx decline, and you'll see a boost in that free cash flow, but you're going to have to be patient. This is something that a long-term investor will buy, not necessarily a trader. Now, with that said, I'll look at a chart later, and it is looking like it's bottoming, so some traders might actually get into it and you could see a pop. But see those big names, those Magnificent Seven names, the Amazons, Microsofts, Alphabets, Nvidias, Broadcoms, they fund expansions organically. Oracle's relying on debt. Now this leverage is going to amplify risk reward. It amplifies the upside potential, but also the downside risks. So most recently yesterday, you saw Oracle stock dipped 5% as Blue Owl Capital pulls out of funding for $10 billion data center. Of course, that's going to spook the markets, especially when sentiment's already bad. But keep in mind, this is $248 billion in lease commitments over 15 to 19 years. And as I posted in Discord last night, keep in mind that this is one data center project out of dozens. But of course, it's going to spook the market, and the stock was already under pressure. Now, if you look at the valuation levels for Oracle, it's back to 2023 levels, as you can see on this chart. So this is a massive parabolic run up and then coming back down. And so earnings also helps with this too, right? So it's going to grow into itself with earnings, but this was way ahead of itself up here. This is like a 28. Now it's back to something like a 13. And this chart speaks volumes. This is Oracle's debt and free cash flow. So you can see this orange color. This is free cash flow. And this was positive, and now it's significantly negative. And it's been positive going all the way back here to 2016. In addition to that, you're seeing the company's always had some debt, but you're seeing that debt go higher now at all-time highs. And of course, the stock price is impacted as well down here. It's starting to look attractive. I want to show you a chart. Now, when this stock ripped up to $345, I told Discord, don't be surprised if you see this stock below $250 later. It's probably a good area to trim, 325 and higher. And I said 195 to 215 was possible. Of course, it went lower than that. It went to $185.63. And honestly, guys, that's part of why this channel is so valuable to you as a retail investor. I'm a retail investor myself, but being on an island is very difficult. I bring information and insights to you to help you make better decisions. And I often do that well before you hear anywhere else. So if you're new here and you haven't subscribed yet, please do that now. Click that bell for notifications. 2026 is going to be epic. Now on this chart, you can see that there's a possibility it goes lower, something like 168 here on a S2 Fibonacci, 137 S3, but it looks like it's starting to bottom. It is coming back to these levels. It did get down, I think, to 177 or something yesterday, but 175, more than likely it holds something in that level and goes the other direction. Now, there are definitely risks to this stock, and it's not dirt cheap by any means, but overall, the company is still very healthy. If you look at at the blended rate, we're talking about 68% gross profit margin. Now, of course, you're not getting 68% from these data centers. It's lower, and they expect that to be something like 35% longer term. But it's driving down the existing business, and some people saying it's making it worse. If you're investing in this company, it's really about you believing in the long-term narrative that this is going to play out. But growth is, it's solid overall, but this is a mature company. It pays a dividend, right? So this is going to be more of like a DGIF type company. 1% dividend, 29% payout ratio. It's got nice growth rate here, 14.63%, 11 years of dividend growth. And looking on Seeking Alpha here at the valuation, you can see 31 forward gap PE ratio. So it's not dirt cheap. It's also not crazy expensive. So for the right blueprint, Oracle could be a great stock to add. With that said, a couple of things, and there's really two sides of the fence. The first, I believe, and I think Ivana mentioned this on one of the podcasts as well, but the street really missed out. They kind of missed the boat on Oracle. So it's not surprising to see institutions trying to drive the price lower. A lot of them weren't positioned well, and they want to actually add the stock. The other side of that, I've been doing this for about 30 years, and I know that when sentiment's really bad like this, it's very hard just to reverse it overnight. And so this stock could rip from here, and if you're a trader, you could get on that momentum. But I also wouldn't be shocked if you're a buy and hold type investor, if you buy this stock and it comes down to these levels again, or maybe even lower, that wouldn't shock me either. So you really have to have conviction in this stock that you want to own it long term. I believe that Oracle long term is one of the best high conviction names in terms of Swan, sleep well at night, where if I invest money today at these prices, I'm confident in 5 or 10 years that I'm going to make more money. That does not mean it's going to be the best performer you can possibly buy. It just means the chances of Oracle not making money in 10 years, in my opinion, are very low. So when you talk about bubbles, generally a bubble, there's going to be mass hysteria, lots of FOMO in the market, not a ton of negative sentiment. Everybody's really on one side of the fence. What's interesting about it, there's a lot of negative sentiment about stocks like we just covered, Oracle, but also Nvidia and really all the AI stocks. You keep hearing it over and over. They're too expensive. It's not sustainable, blah, blah, blah. Well, Micron had earnings last night. Micron was up huge this morning, like 15%. And if you look at those earnings, Wells Fargo analysts pointed that Nvidia likely accounted for 17% of Micron's revenue during the first quarter. Of course, this is boosting semiconductor companies today and really AI stocks in general. And that's a great segue into Nvidia's chart. We'll also look at Broadcom and a few others like Astera Labs. If I didn't already own Nvidia, I would consider buying the stock $175 or less DCA. It certainly can go lower. You can see this S3 Fibonacci is 144.17. A lot of people on the internet saying, hey, if it goes under 150, load up. More than likely it won't happen because a lot of people are on that side of the bus. Everybody on that side of the fence saying it's going to go below 150. Usually it doesn't happen. When everybody thinks something's going to happen, it rarely does. You can see it is starting to bottom here. And I do think that next year, I've said this many times, the stock will be between $250 and $300 a share. Now that doesn't come risk-free. It never does, but the risk reward is pretty attractive here if I don't own it. And yes, the valuation is expensive. Rocking a 37 gap forward PE. Couple things on that though. Because AMD is a $322 billion market cap and Nvidia is a $4 trillion market cap, a lot of people are going to tell you, well, buy AMD because it's cheaper. It's not really cheaper. In fact, it's a 77.86 gap forward PE ratio. Now, on top of that, AMD is showing 25% forward revenue growth here on Seeking Alpha, whereas Nvidia is showing 73%. So you have quite a bit more growth and it's actually a cheaper valuation. Is the market cap higher? Of course it is. Does that mean AMD is a better buy? Not necessarily. Do I own both stocks? Yes. Speaking of AMD, so we told you 250 plus might be a good trim area. Probably pulls back to something like the 100-day moving average. What's crazy about it is this green arrow was here before the stock got here, and you're actually seeing buyers come in right where this green arrow is. It's pretty awesome. I'm not necessarily a buyer of AMD at $202. We were big buyers of AMD when it was $100 or less DCA. If you follow this channel, you know that. So our buys were focused $100 and less DCA. We even got some like at $77. It ripped all the way to 267. A lot of members did trim some shares there, 250, 260. If you missed that whole rally, of course it can always go lower. This S3 Fibonacci is something like 155, but buyers are coming in, probably holds that psychological floor around $200 a share. It could break it down to 195 or something like it did, but $200 is generally a psychological floor. It could hold here if the greater market holds up and rocket back up. I don't think it's going to go to this previous R3 anytime soon. That's it at $334. The current R3 is something like $293. It's going to have to fight up to $250, retest this $267. It's going to take some work to get up there, right? And I just showed you the valuation. It's not necessarily cheap. Of course, do what's best for you in your portfolio. And I will say that the market is oftentimes a self-fulfilling prophecy. If everybody says, I just told you, if everybody thinks one thing's going to happen, it doesn't always happen. But if enough people get on board and say, hey, Palantir should be a $200 stock, crazy things can happen as well, right? So if everybody says AMD is going to be 250, 300, 350, it certainly can happen, especially if people are buying this stock over Nvidia. I own both Nvidia and AMD, and I am bullish long term. I recently did a Patreon exclusive, and I said that, hey, this is probably going to come down a little bit lower, but I really like it when it gets in this yellow circle, and it's kind of at the top of that yellow circle right now. Certainly could go lower. It could also bottom any time because it is a high demand stock, high quality. But this, like many stocks, have ripped $137 all the way up here to over $400 a share. That's a massive rip. So oftentimes you see a 50% retracement, which would be a little bit lower than it is, but you do that circle, you're kind of at the top of that circle. The reason this circle goes down here is a trend line. I don't think it's going to get to the trend line necessarily. The 200-day simple moving average is $283. Broadcom is also one of my top 10 high conviction stocks is Swan. I like it because it's a blend of semiconductors and software. It also has things like cybersecurity with Carbon Black. So Carbon Black is an endpoint security company. It was acquired in part of the $69 billion purchase of VMware in late 2023. A lot of people don't know that. This is a hyper growth stock that I really like. And I told you guys to buy it when it was $85 and less DCA. Even $100 and less DCA was attractive. Of course, it ripped from $47. And this is a DCA battle because you're buying at 100, you're buying, you're down 30%. All of a sudden, boom, $47 to $262. We talk often about 50% retracements. This came in and did a 50% retracement. 150 is that 50% retracement level. You take 47.13 plus this top number, divide by 2. It certainly can go lower. The S3 is something like $95.59. $100 is probably a psychological floor. But if you're buying the stock here, we can actually move that up. Here's where it's at today. Here's your downside, really, if you're thinking 95 is the floor. Of course, it can go lower because you just saw 47, but I do think 95 is probably a decent floor at this point because we have a couple earnings reports that have been very, very solid. So your downside is something like $50, and your upside, well, it depends on where it goes, but 262.90 was the previous high. This R3 is something around 230. I think ALAB can be a $300 stock, but it might not happen overnight. It could happen in 2026. It might take to the first half of 2027, and it's going to be dependent on earnings. But if I'm a long-term investor and I'm thinking 2 years out, I think the stock's probably going to be a $300 stock in a couple years. So if I buy it at $147 and it doubles in 2 years, I feel pretty good about that. In the end, guys, always do what's best for you and your money. Build a blueprint that matches your DNA, what you believe in. Remember, when you buy a stock, you're owning part of that business. Any guesses on which stock we're looking at right here? This is another one of my Swan stocks. High conviction for the next 10 years. I really like this company. I really like this stock. I want to buy more shares. Now, this is third quarter 2025. You can see the numbers are very solid. The stock has pulled back. Some geopolitical risks, some inflationary type risks. There's always going to be a little bit of extra risk because this is about Latin America. Now, people call MercadoLibre the Amazon of Latin America, but that's not really a fair assessment because MercadoLibre, a big part of their business, actually runs on Amazon Web Services. And MercadoLibre doesn't have any cloud services. But in terms of the e-commerce part of the business, very much the Amazon of Latin America minus cloud services. Now, if you look at this chart here, this one on the left is showing you Mexico in this gray color, and you can see significant growth. Argentina in this light yellow color here, and Brazil, which is where most of their business is coming from. This very small sliver you see here, this darker gray color, this is others. There's a tremendous amount of TAM, total addressable market, to grow business in other areas within Latin America. I really like this company, not only because of the TAM, but it's also a hybrid between e-commerce and fintech. Now, if you follow me closely, you know that I'm not a big fintech fan. I generally don't invest in fintech, but I really like fintech when it can be part of a larger conglomerate like this and create network effects. And when you look at the data, Mexico, Central America, South America, very underbanked. This infographic shows you exactly what I'm talking about. This is population over 15 years old, according to World Bank data. The yellow is going to be bank account, and that gray color is going to be credit card. So if you look at China, 89% of the population over age 15 has a bank account. 38% has a credit card. The United States, 95% have a bank account, which actually is a little bit surprising to me because over 15 years old, so 16-year-olds have bank accounts, I guess so. 67% have a credit card according to this data. When you look at Argentina, those numbers drop significantly. 72% for a bank account, only 29% for credit cards. Mexico, 49%. So over half the population doesn't even have a bank account, and only 11% of the population of Mexico has a credit card. Brazil, 84%. And a lot of this is thanks to MercadoLibre, 40% with credit card. In Latin America as a whole, 74% versus 28%. So massive room for growth in fintech. And the reason this is important, this is where most of their margins, their higher margin profile comes from this segment. Now, on top of the fintech, let's look at e-commerce. This is retail e-commerce penetration, right? So this is the penetration rate. Up here, you've got United States and you got China. Down here, this yellow is Latin America, and you can see it's significantly lower. So tons of room, total addressable market for both e-commerce as well as financial services. And here's some food for thought on that topic. What do you think happens as more people have access to satellite internet? You got things like Project Kuiper. I think they just changed their name, but Amazon, of course, you got Starlink. As Latin America gets more infrastructure, has more connectivity, more and more people are going to have access to the internet, and it's going to be huge for companies like MercadoLibre. Now, on top of that, if you look closely at this chart, the yellow is e-commerce, and this is the long-term goal here, 45%. So about half of the business is going to be e-commerce. And you also have to add this 12% because this is tier one. This is them basically selling direct. So if you add the two yellow segments right here, it's 57%. 57% is going to be e-commerce. This is fintech, and this is where the highest margins come from. But you can also see this light blue, which is credit services, and you can see that's growing pretty significantly to 19% for their longer term goals. This is the margin profile. So e-commerce is going to be 37% or so. This is going to be the gross margins. Fintech, you can see, is significantly higher at 60%. Now the credit, that's that services part that's going to grow to 19%. The only bad part about it is it's actually lower margins than e-commerce. That's one thing to point out as a long-term investor because the margin profile could actually shrink. We really want this segment to grow the most, which is the fintech, the credit cards. The consolidated margins you can see in this green color, and so you're getting somewhere around 45% blended. And just in case this isn't clear, this credit sub-segment, we're talking about loans. So Mercado Credito. That's my attempt at being funny today. You know, the sad part about that is I actually have a degree in Spanish and I can't speak it at all. I can read it pretty well, but I can't speak it. But this includes loans for consumers, for purchases, and buy now, pay later installments, as well as merchants and working capital loans. And something to point out to you guys, I mentioned this, but it's a key growth driver, but it's also margin dilutive, especially in the short term because of front-loaded provisions for loan losses. And anytime you have loans, it complicates things. So it's something that you need to know as an investor. And as you guys know, I can talk for hours on each stock, but we don't have time to do it on YouTube. But hopefully that last segment, hopefully that's something you haven't seen before. And if you're an investor in MercadoLibre, it opens your eyes to what the future of the company could look like. You know, so overall with profitability grades an A+, it's bringing in about $25,000 net income per employee. It's going to have quite a few employees, kind of like Amazon. You've got distribution, you've got logistics. You know, not nearly as big as Amazon with 1 million+ employees, but we're talking about 112,000 employees end of 2025. And keep in mind, this is a $100 billion market cap, whereas Amazon is rocking $2.42 trillion. So don't get this twisted like the whole AMD Nvidia thing that MercadoLibre has to grow into a $2.5 trillion company overnight because Amazon's $2.5 trillion. But $100 billion, you do have room. You can 10x to get to a $1 trillion market cap on MELI. And the growth is solid, you know, especially for a bigger company, $100 billion company with a 36% forward revenue growth. Valuation's not cheap. It's a high demand company. 47.78 forward GAAP P ratio. The stock's only up 9% in the past year, and it's up 16% year to date. And I do like this stock where it is below $2,000 DCA. The closer you get to this blue trend line or under it, the better. You also have a Fibonacci S2 here. That's gonna be 1815, and this S3 Fibonacci is a 1628. So it certainly could go this low, and I would love to buy more shares. It gets closer to $1,500 a share, but I do like it under $2,000. This trend line's around 1850, and it hovered just around $1,900 yesterday. Did add some in the community portfolio. I've already covered 5 stocks, but a bonus one here. This is one I've actually been buying in the community portfolio. $2.1 billion in 2024 annual revenue. And then the ARR, the annual recurring revenue, $1.3 billion. So this is going to be a blend of hardware and software. On the hardware side, primarily it's going to be tasers, but also things like drones are getting more popular. And of course, you have the body cams. Now, the connected video and sensors is huge because it allows a software as a service product, essentially where you can get streaming and cloud. I think there's a lot of upside potential in the future for drones and robotic security as well. It's a really cool company, and we could spend a lot of time digging into it. This is AXON. About half of the company's revenue is going to be recurring, so like a SaaS model. Because of that, it's going to carry a higher valuation. If you look at the PE ratio, the gap forward PE is at 371. So the cloud metrics on this EV/NTM revenue is 13.4x. Rule of 40 is 46%, and the net dollar retention is 124%. Now, most SaaS companies are going to rock something like 75, 80, even 90% gross profit margin. This is around 60% because of that hardware blend. The 52-week high was 885.92, which was way ahead of itself. It's now down 7% in the last year and down about 5% year to date. So AXON was way ahead of itself at $885 a share. You can see this is what we call an air pocket. This is your trend line way above this trend line's air pocket. You can see most of that air pocket has collapsed. It looks like it's bottoming here around $508. Nice bounce off of that. It's $566 right now. We've been dollar cost averaging $550 or less DCA. It's a little bit above that right now, but I do think the trend is upwards. Now, it can always go lower. You've got S3 here and trend line closer to $366, but I do like it here, $550 or less DCA. If this video was helpful, make sure you subscribe to our channel. Click that bell for notifications. Drop me a like. Drop me a comment. Have a great rest of your day. Take care.